Thank you all for joining us. We have a fantastic conversation for the next 35, 40 minutes. And it's something a little different from maybe what we've been talking about over the last 2 days. This is really designed for entrepreneurs, founders. I know that there's a chief exit officer in the room as well, who are thinking about exiting and how can they best go through that process. What do they need to know in thinking about and positioning themselves for a lucrative exit? What are the key factors that you should consider? And what do you need to do when you start thinking about it, and when? So we have a fantastic panel to talk to us about that. They are entrepreneurs themselves in some cases, they are investors, they're experts who've been through this many, many times. So my job today is to talk as little as possible and to let them bring their expertise to the fore. We are going to, if we can, take a little time towards the second half to hear from you. So if there are some roving mics, I'm hoping there are some roving mics, we might use those. I want to start by asking each of you the same question. It's a very broad, generic question, and then we will dive into that, which is, what are the most important factors that a founder should think about when they're considering exiting? And maybe I'll start here on my immediate left, Abdulaziz, who's the CEO of impact46. So Abdulaziz, just give us 2 or 3, because you've got other. What do you think are the most important things that a founder should think about when they're considering exiting?
Okay. Thanks a lot for the introduction, and thank you for this opportunity to speak in front of this esteemed group. I would say I'd like to share experiences. Maybe that's a better way of resembling how we think about exits. Generally, in the tech industry, a strategic buy or a strategic sale is usually the most common exit route. Here in the region, unless you're here in regions like ours where you don't have as many strategic buyers. So what we thought is lacking here is probably large listed companies that we thought we should support. Large tech companies get listed and on the hopes of them becoming strategic players in the industry. So far, at Impact46, we've helped 2 large tech companies get listed with a combined value north of $4 billion so far. We think these listings have helped foster a more dynamic exit scene. So you've already seen these listed companies starting acquiring other smaller players. So choosing the right region or the right fit for every region you are in, I think is very important and essential. We think these 2 listings have fostered a more dynamic scene and definitely added to the momentum of investment in the tech industry.
Fantastic. So actually, let me pick up that point if I could, and pass to you, Rishi. Rishi Kapoor, Vice Chairman and CIO of Investcorp. You work within the region. You were just telling me you've spent most of your life here in the region, but I also know that you work outside of the region. You just made a really interesting point, Abdulaziz, which is you have to be very cognizant of what's going on in your region, what's specific to your region. So tell us a little bit about what you're seeing and how maybe this region differs from others, or if you're looking to exit elsewhere, perhaps, because this is a very international crowd, what you might be thinking about.
Sure. So I'm going to take it back a notch to a slightly more macro perspective first, and then come back down to the micro. You know, we've been investing in founder-led businesses now for over 4 decades, right? So we've accumulated a body of experience just having worked with very smart, very talented founders, you know, through the US, through Europe, through here, and other parts of Asia. And I have to say, when you look to address the question of exit, you have to break it down into its 2 or 3 component parts. First of all, a typical founder has to think about 2 exits. One is, for himself or herself from their managerial role, the executive role, and second is for themselves from their shareholding role, because the 2 are not the same, right? And if you think about some of the biggest, founder-led businesses that are, $3 trillion in market cap today, each of the owners, like Bill Gates, for instance, right? Bill Gates is still a shareholder. He's not involved in the executive leadership of Microsoft. Now, that's an extreme example, of course, but nevertheless, it's important to differentiate between the 2. But more importantly, the real question that a founder needs to face up to very early on when bringing in outside investors is differentiating between his or her own exit versus the exit that he provides to his investors, right? Those are 2 different things. A typical founder will typically want to continue to have that skin in the game and that pride of ownership in their business for a much longer period of time than a typical financial investor like Investcorp would. Because we are representing fiduciary capital, right? We are representing the capital of investors that have deployed their savings over a lifetime into those investments. They want to see a return, and they want to see that return being crystallized, right? So hence, our horizon tends to be the typical 5 years. A typical founder really should not be thinking anything less than a couple of decades, right? Because that's how long it takes to create true sustainable value in a business. And I think going back to the question that you kind of posed earlier, Zania, in the region in particular, what we have seen now is a clear embrace of that reality, where on one hand, earlier it used to be difficult for family-owned businesses to accept outside capital in a manner that they found amenable, aligned with their own objectives. That has changed. The next generation of entrepreneurs and founders are much more willing to take on that capital and have that capital come on alongside them, perhaps even in a majority manner, as opposed to just a passive minority. That's a big positive step. But on the other hand, those very same founders are also accepting that it is a cycle, it's a daisy chain. You bring in a set of VC investors initially. You have to be able to think about being able to provide an exit for that venture capital fund or whatever the case may be 4 or 5 years down the road. And that exit may not be an IPO. It may be an exit to a growth capital investor, also a financial investor, and subsequently to a buyout investor. And you are eroding some value of your shareholding along the way, yes. And ultimately, you may end up owning just 10% of your company, and 90% is owned by the private equity investor or whatever the amalgamation of that source of capital is. And it goes endless, but you still hold on, and you kind of provide that daisy wheel, as I said, of value.
And I'm going to come to the audience in 1 second, because I have a question for you, which I think is relevant for this conversation. But what you're essentially saying is the founder needs to keep at least 2 timelines in their heads at the same time. One is the investor timeline, which is a 3 to 5 year time horizon, and the other is their own personal timeline, which is decades long. Yeah. Can I ask a question of the audience? Hands up, how many of you, and you might answer yes to both of these or even no to both of these, how many of you are entrepreneurs or have been entrepreneurs? Hands up. Okay, so there's about a third of you to a half of you who have been or are entrepreneurs. How many of you have been or are investors? Okay, so this is mostly investors in the room with a few entrepreneurs. Interesting, okay. I am definitely...
It's the FII. Right?
It is the FII, but I keep bumping into entrepreneurs who are here because they want to meet all of you. So maybe you've all kind of shut yourself in here just to get a little bit of breathing space. So I'm definitely going to come to you for questions, because I want to hear both what you have to say, but also what you want to hear from. But Kazai, I want to come to you now and ask the same question, which is, from your perspective, you are both an investor yourself as the CEO and managing director of Sadu Capital, but you're also the CEO and founding member of the Saudi Venture Capital and Private Equity Association. So from where you sit, and I think you've also been an entrepreneur,
Sedu is a startup.
Is a
and so on.
startup. Okay,
Yeah.
so as an entrepreneur, as an investor, talking to a group of entrepreneurs and investors, what is most important to you to think about in terms of thinking about the exit? And I think you do a lot of early seed capital stuff, right? So how does it play into your thinking? Maybe that's a better question for you.
Certainly. So in Sedu Capital, we invest in the early stage, pre-seed, seed, and Series A. And people might think this is too early to think about the exit. Certainly, the founders think it's too early to think about an exit at that stage. And I agree to a certain extent. But I believe that one of the major things that we do in Sedu, which is called Path to Liquidity, it's an amazing exercise we do with the founders, where we articulate the story of the company. This is us today at the seed stage. So how many investment rounds we think the company needs. At each investment round, how much capital do we need to raise? At what valuation? So we would manage the dilution. Also, Rashi highlighted the timeline of the investors. We will add the timeline of the investors to that path of liquidity, along with what should we provide our customers? Where should we expand globally towards and fuel that with the capital in each stage? And that story is not accurate. It's full of assumptions, but it helps the founders know where to go and make adjustment along the way, and us as investors with them. And usually it becomes more critical as we approach an exit or a new late stage investor comes in. They could re-articulate the story with them till an exit. If I may say to myself as a founder, if I plan about exit, I would say start early, build bridges, and build the inner house or the back of the house early on. Start early, you will make a lot of mistakes, and you want to learn from other people's mistakes. So allow yourself time to make few mistakes before you approach the final moment of an exit. Build bridges. You need your stakeholders, your investors, your C-level, your employees to be aligned and involved in the story of the exit. Also, you will engage external investors, external advisor, financial and legal advisors. So you need to bring them in, build these bridges. People will help you. If you align that vision, just like in Saudi, when we all aligned behind one vision, we started moving towards a goal. You having your own vision within a company, so you want to bring people along the way. The third thing is, as a founder, you think about scaling, growing the numbers, expanding globally and regionally. But as you approach an exit, you need to think differently. You need to think of your C-level, succession plan, governance, committees, if you're going public, or strategic alignment if you're being acquired. So these are different things to think about before you approach an exit.
I'm going to ask one more question up here, and then I'm going to come to the audience. And I'm not going to ask you each. I want to get a smattering of what are the questions and thoughts that you have out there, and then we'll come back here. But give me, each of you, if you will, one case study that was either a really successful exit. It could be one that you managed. It could be one that you looked at from afar, and say one word about what made it successful, or you think was a real failure, and what was the mistake made. Who wants to start? You want to start?
Sure, I don't mind. To be honest, there hasn't been that many exits, not too many exits in the region. We pride ourselves for, I think, 8 exits so far, but it's still a small number in the larger scheme of things, larger scheme of number of deals that are happening. I think what these early exits help to do is that, especially the listings of these 2 large tech startups, it helped create a benchmark or a thermometer for other VC deals. So we've seen, I think and a lot of the investors in the room, since most of us are investors, I'm sure noticed that every venture capital deal that happens in the region, everyone before closing, they'll look at the Jahez and Rasan stock price. Where is that trading at? And take the effective multiple. I think adding that level of transparency is critical especially for later stage investors like ours, maybe not as relevant for early stage investors like Qusay, where growth and time will change everything. But for us, where we invest slightly later and after that stage, I think it was critical for us to have a benchmark or something to compare to. I hope we can get many more benchmarks. I know I'm maybe overstuck on the listed companies, but I truly think it's a missing component in the market here, and especially in Saudi, I think we're well poised to become the hub for every tech listing in the region, every significant large tech listing in the region, because I think we have a really well-developed capital market framework.
Is there one thing that you think for one of those two listings that made it successful? One characteristic of the listing, one thing that they thought about or that you thought about that made it particularly successful?
A few things about the company, because the companies themselves, they are platform businesses, so they thrive on scale, and they continue to maintain that high growth status, which is really valuable, let's say, in capital markets. Another very important element is that they still are a rare commodity, and I mean, high growth stocks are still rare in our region. Okay. So for investors, if any capital market observer thinking of diversifying his portfolio or constructing a portfolio, he would like to have some level of high growth component, and I think very few are in the region, and I'm sure the two tech startups will be well on the top of that. So, and we still have a long room to go, a long way to go. If you look at other examples of more developed capital markets, it should, I mean, high growth technology companies should constitute at least 20% of the market. We're nowhere near that yet. So we still have a long way to go.
Okay.
Yeah.
Rishi?
I mean, I think what I'll do is I'll try and incorporate both the challenge and the opportunity into a single story. And I think many people in this room actually may be familiar with it because it's on Netflix. It's called Gucci. So Gucci, if some of you remember, Investcorp initially, when we invested in Gucci, that was the first time they took external capital, financial investor capital, into the company. It was founder family led and owned till then. It was not an easy ride initially because of the missing level of that alignment and so on. But over time, working together with the family, and despite some of the challenges, etc., we were able to bring in, this is what I was referring to earlier, bring in professional leadership and management into Gucci in the form of the CEO, Domenico De Sole, and of course Tom Ford, the key designer, and slowly but surely we started laying down, as Aziz was saying earlier, we started laying down the foundations of what defines a good exit story on the public market, which is both profitability, but equally importantly, the growth prospects going forward, right? And we were able to take Gucci public in a very successful IPO in 1995. That was 6 years after we had made the initial investment, so a little longer, but well worth the wait. But more importantly, we didn't exit at the time of the IPO, right? We held on to our shares, or most of them. And we actually exited progressively over the course of the following few years. And remarkably, in between, Gucci went private back again. Right?
Interesting. Yeah.
So this is that whole, it kind of illustrates that whole cycle that I was talking about earlier. IPO is one form of value crystallization. It's not necessarily a monetization event. Doesn't have to be. And secondly, it's only one of those options. You can actually pursue monetization through different channels. In all of those, it is important to be able to craft, sell, and validate a compelling equity story.
Yeah.
You have to think ahead, right? 5 years ahead, 10 years ahead for the next investor. Not what you are exiting, but what that investor would be exiting into. If you can do that and make it compelling, you'll get value.
So it's So I'm a coach in addition to being a moderator, and one of the things we often say is put yourself in the other person's shoes.
Yes.
Quite literally, and what you're saying is it's not just about your story and how you're going to make equity out of it, but actually it's about how the person who's going to buy it from you is going to make equity out of it as well. So look at least one, if not two steps ahead. One quick story from you, Khazai, and then I'm going to come to people in the room.
So I loved what Rashid said. Before you harvest your value, make sure that the other farmer will find something else to harvest. It's amazing. On a previous fund, we've invested in a tech company. That tech company was well established. Top line was ready for the public market. Bottom line as well. Two things that we did really well, beside other things that we've learned from that experience. Alignment of interest. The C-level and the CEO had incentives within the company aligned with the exit. So as soon as we exit, they will own X percentage of the company towards the exit. So that kept them motivated, eye on the ball, and pushing even during tough circumstances. That's the first. The second thing that we've successfully managed, the company listed just after the pandemic. There was a lot of uncertainty. The tech stocks really soared and then fallen. We did not know what to do. So the best option was to direct list the company instead of initial public offering. The direct listing does not means that we don't have to sell at the current price, but the company will be listed at a certain price and will trade till it finds its ultimate price where we could exit gradually on as we really liquidate our ownership. That was choosing a better instrument for the circumstances of the market.
Okay, great. I want to come here because I know there's expertise in the room. So if there's handheld, I'm not going to stick your hands up. I want to get 3 or 4 comments, thoughts. What do you want to hear about? So this gentleman, and then come to the front row. And if you can make it just no longer than a minute.
Oh, don't worry, I won't talk. I want these guys to talk.
Exactly.
Just a quick one. What are the characteristics of a company you think should go IPO? So the revenue, does it need to be profitable in this region? Obviously, America is very good at scaling unicorns without profit or even revenue. So what are your thoughts in this region specifically? So if you're going to say, this company has to be X, Y, and Z, we're going to take it and we're going to run with it.
Okay, so what are the characteristics that make a good IPO in this country?
Right now, or you think are going to be viable in the next 2 years?
Okay, perfect. This gentleman.
My comments cover venture capital. Rishi obviously is talking about private equity. So as Abdulaziz mentioned, we need a lively IPO market to reflect our investment in a high-growth technology sector across the region. And today in the Arab world, there are only 3 listed technology companies. 1 in Egypt and 2 in Saudi Arabia that were led by impact46. We would like to see a bit of an American-style listing mechanism where you can actually list non-profitable, high-growth tech companies with, as Rishi said, a very good equity story. We're not there yet, but this is something and maybe I can get comments from the audience about that because that's important. Abdulaziz, when Jahez listed, they were already profitable.
True.
And Razan is profitable.
True.
So that's the other thing because remember, public markets lowers your cost of capital dramatically from maybe 50% to 15%, so it's much more efficient.
Okay, great. Any other comments, thoughts? So I'm going to take these 2 gentlemen here, maybe the gentleman at the back, and then come here to the front, and then I'm going to come back to you. You don't need to comment on anything, everything. Just choose something.
2 points. First, with respect to the listing on the Numu market, in Saudi we have witnessed a non-technology company listing while losing money, and this was a precedent in the market. And the Numu market in Saudi is a perfect venue for technology companies, whereby the investors are sophisticated enough to understand the value and the added value of the founder. 2, the regulator deeply understand the process of going public and specifically the characteristic of technology companies. And we have witnessed, successful IPOs of impact46, Jahez, Rasan, whereby the review process was very smooth as well as the placement. Second point, With respect to question to the gentleman, with respect to the private market, we have a very successful and very active private market in Saudi, whereby partial exit and full exit of technology companies through private sale. So we would like to hear their views about valuation, private market versus IPO.
Okay, so we've got 3 questions, and then this gentleman here. Private markets versus IPO. To this gentleman here, please.
Yeah. So.
In the back on characteristics.
Okay.
Hold your thought.
Sure,
We're going to get one more comment. You don't need to answer them all. You just pick up the thread that you want to.
Just a quick one. What will make strategic acquisitions happen, whether from global players who want to enter the kingdom instead of doing things, or from big local players, whether they're listed or they're private? Because we don't see that much as a form of exit yet, at least. But what's their thoughts?
So strategic acquisitions, what needs to change in the market in order to become more Americanized, characteristics and kind of benefits of private versus public? Just take one of them.
Oh, I can take all 3. But first of all, you don't need to be profitable. That's clear in all the regulations, all the capital markets regulations. You need a certain size to decide whether you go on the main market or the parallel market, as Ziad was saying. But there is no need for you to be profitable. We chose profitable companies because, don't forget, they were the first 2. We didn't want to take chances. But I assure you that we will most probably have 1 or 2 that may not be profitable that we're planning to take public. So it's not essential for it to be public, but the size certainly matters because for the costs to add up. I'm happy to. I just want to take the strategic answer, strategic acquisition. If you look at to the point Rabia was saying around lower cost of capital, I think listed companies generally, I know I can't explain the reasons, are more aggressive in acquisitions, and we've already seen that in Jahiz and Ras. And I tell you, in Jahiz, I think between the announced and the unannounced investments, at least 8 investments, acquisitions that were completed, and let alone the ones that were studied. So they did spur a wave of acquisitions. As we see more companies going public, I think that will certainly help strategics. And I would only bank on locals to start before internationals. You wouldn't expect international investor to be ahead of a local investor. I think locals will certainly do it more. On what to worry about, listing here, most companies I see, they're not very sure about listing in Saudi or elsewhere, so they don't really re-domicile themselves in Saudi properly. So keeping all your options open doesn't really work. You need to take a call and say, this is the market I want to focus on, and that's the way for you to access the capital markets. For you to have halfway, I don't think it works. Sorry if I took too long.
No, sure.
Let me add a few things, and I'll also pick a smattering of the questions posed. So on the strategic acquisition side, actually, the way I think about it, or the way we think about it, is it's one of the first things you consider when making a new investment yourself, because an exit to a strategic acquirer down the road is something that ought to be part of your base case underwriting on day 1, and you start working on it on day 2, right? We've done it many times. And it takes that long to court and woo and establish that connectivity, etc. And in every instance where we've had that thought process established well in advance, we actually have done well. So a strategic acquirer can be actually a good exit pathway for a company. That's one. Second, on the valuations for private versus public, I'll tell you there's a very simple difference between the two. The public market for technology companies or anything, right, will value the company for the next quarter. The private market will value the company for the next 5 years, right? And that's it, right? It's basically one is driven by sentiment to a large extent, in addition to obviously all of the other considerations, growth and equity story, etc. Whereas the other is driven by long-term value creation potential. Last but not least, on that question about how should you prepare a company for an IPO. Look, guys, it's very simple. You need to figure out who your target audience is, who's actually going to invest in the stock. And based on that, you need to be able to hit their metrics rather than try and push your metrics on them.
Okay. take us home in 30 seconds.
Sure. To complement my fellow panelists, I will wear my association hat. So one of the major roles in the association is to enhance the exit environment for all of us fund managers. Today, Tadawul, the Saudi public equity market, is ranked amongst the top 10 globally in terms of value and in other metrics of trade volume. That made it a very attractive market to exit. The secondary market is facing some challenges in terms of liquidity. We are in talks with the regulators to enhance the liquidity there. We provided certain recommendations. The Capital Market Authority already have a few exciting ideas. We also did an analysis on the M&A activities in the region, in Saudi, Egypt, UAE, and many other countries. We still behind our global fellow countries. We believe, as Abdulaziz highlighted, the more listed companies in the regional markets, the more the activity. We started doing some awareness campaigns for large companies. The association provided an M&A training program for large corporates and founders to make them collaborate and work together. I believe it's a journey. We're going to work together to enhance the exit market. And I think we're onto something.
Onto something. So finishing on a pretty positive note, I think. Thank you. Please join me in thanking our panelists. And my hope is, if you have any further thoughts or comments, my hope is they might stick around, but go outside, because I know that there's another panel and we've taken a little bit longer. So
Thank you.
give them the...
Thanks so much.
Thank you all very much. Thank you.
Enjoy.